Important information and disclosure. TDW Trader Live seminar presentation is for educational purposes only. All trading ideas discussed by the instructor are for demonstration purposes only. Trading involves a substantial risk of loss and is not suitable for every investor. Past performance is not necessarily indicative of future results. Please read more at https://ttwtrader.com/disclaimer. Okay, welcome back to our Day 5 strategy pattern, and we are going to the execution summary of. Then we are starting to dig a little bit deeper into bookmap and show what bookmap can offer us additionally to that what we have talked about. Before we continue with the execution summary, I would like to make the preparation for today with you to show my approach as presented and shown yesterday. The preparation will guide us through the exercises based on live ES future data. Let's do the prep, and it was the question, if you are loading data from the last days here, what are you looking at? Where are the limits, for example, where have been the liquidity levels and so on? That's what I would like to go through. First of all, I've told you and I showed you yesterday how you can hide everyone on this chart on bookmap live. You have nothing on your bookmap here. These are my levels for today. I've done my prep work a little bit earlier, so to show you what I'm thinking, what is going to happen or what can happen. Don't look at these levels here, but what I have here is the POC. I leave it on the chart. So if you deselect all those parameters here, then you got an empty chart here. Okay, now what I'm doing is adding candlesticks to the chart, simply because I see the highs and the lows very very exactly. It's not blurred around with liquidity areas or whatever. You see it very clear and sharp where the highs and the lows or the swings are. What we can do, or what you should do if you want to, compress this page so you see then all the past days, or the loaded last days history data here. My first step is to see where are the lows, for example here and here. Where are the highs? Here, here and here, and also this one. So this is our first estimation of possible swings. You can add as much as you want. The question is, does it make sense to do so? What we have marked now are the swings, the yesterday swing here. What we got is the swing highs and swing lows. So you can draw a lot of lines in this chart, but I recommend only to use the biggest one, so that you have the first, so that you have a first orientation on your chart. That's important. Then go back, deselect the candlesticks and mark best bid, best ask, heat map, VWAP, volume bars, volume dots. I think that was it for this chart. And then you see that sometimes, or very often, the lines, the horizontal lines you have drawn in your chart comes together with the liquid areas or liquidity areas, the high liquidity areas of the days before. as well on the high liquidity areas. And yesterday, for example, it was here. That should be or might be a nice and good support for today, 1392. That helps you to be focused on certain levels. And surprisingly, you will see when you zoom in today in today's trading, you will see that those lines here are falling together with a long-term high liquidity there, and high liquidity here, for example, and here below. It's not forming now, the 1393 and 1390, this area, it's not forming now, but this doesn't mean anything. So please keep it simple on your chart, and then maybe during the day it will come up and will show you the hand here at the 93 and 92 area if it drops further down here. You will see, and it's really really impressive to see that the lines you have drawn on the chart in your preparation, when you prepare for the day, they are coming together and fall together with the liquidity levels, and it's notable that these levels might be an interest of trading here. So what I expect today is that the market maybe is going to hit the 93, 94, this area here around that. It can easily happen. And so my conclusion is we have, when I look at the chart, this is an attractor, this is an attractor, and this is the next attractor here, 31 even, 100. And if this breaks, we are going sure to test the next level down. This is the first level. The second one, as I showed you, is to compare to see the correlation sections, the correlation areas. Let me show you the decision table I've prepared. So what is the yen doing? Yen is up, although we have a correction here. What is gold doing? Gold is up, although we have a correction here. What are the treasurers doing? Or the ZB in this case is up with a small correction, but it's always on the rise at the moment. That means we have a good indication. It's not so strong. We should be aware that at the moment it's not so strong, but we have a clear uptrend in the contrary indicators of the ES or for the ES market. That means it's possible, it's really possible that ES is going to sell again today, and we have this 90 level here. If maybe everything can happen, they can also break this 90 level below, but what we see on the first blink when we look at these charts is that we have a strong dollar. We have a strong dollar against the yen, also against the euro. We have ZB, the treasuries are up, as well gold is up. That means always a little bit, there's less confidence maybe in this market at the moment. This is, what do we have? Yes, it's 1 hour before open. And also we see that in the yen US dollar. When we look back, if we can, I can't compress it anymore. When we look back the last days, then we see that we have, yes, overall. Let me annotate this one here. We have an overall rising contrary indicators, especially treasuries, gold, and yen US dollar. So that means that that ES is likely to make a correction. It's not saying we will see a crash or something like that. I wouldn't go so far, but this indicates that ES is in a weak state at the moment. If we see here drop down, then we will see for sure a rising in the yen and rising gold and rising possibly, not possibly, a rising in the treasuries too. So that's, just a moment, so that's our first estimate. Treasuries, Dow Jones, Nasdaq. Let's see at this one, what is the Nasdaq doing? What is, so this ES, YM and NQ, they are in sync so far, as you can see. There's no divergences. Sometimes YM is not following the NQ and as well as ES. And on the other side, we have soaring treasuries here. This is the state of the markets at this moment, 1 hour before they open. We have weakness, we see weakness, we see weakness, we see weakness all over in the US. Depends on maybe what is going to happen today, I don't know. A tweet that China and the US agreed on their tariffs, that there is a good solution, will overthrow every single aspect of our preparation now. The technical indicators, if you want to look at them, so if you are going to the shares, you will see everything is red, but this is the state of yesterday. Yes, I have some news here, and if you want to see any other indicators, it's the confirmation is that it is going down. This is, I think, yesterday's measurement here of this of the McClellan, for example. So what we see overall in the preparation of our daily business, of our daily trading, is that the yes is weak. We have more chances for downside and for the upside at the moment. And please think about that news can skew the trend. If anything happens, all this what we have on our chart and our decision table is past. What we talked about yesterday also, watch for liquidity as first estimate. That's what I mentioned before. When you draw your lines in, you zoom in as much as you can in your chart, then you will see the extremes of those moves here. Keep in mind, this is absolutely important. Now you see how liquidity is formed at 30.88. So we have extremes here at maybe at 15. We had a sweep into the 15, and then now when you squeeze the chart, you see liquidity there is forming since what is this? Don't see the time here. Why? Since 2 o'clock my time, that means 8 o'clock EST, Eastern time. Let's see, let's be surprised. Maybe they are going to trade around this level and then something happens and they go towards this 30.88. This gives us in the direction a good idea what is maybe happening today, and then you are prepared. It's okay. You have to have what I'm posting in the live education room or the trading room. I'm posting 2 ideas what can happen with the extremes, with the support and the resistance levels. We have to be flexible, of course, because we can't foresee the future that's normal for us humans. Unfortunately, we are prepared and we can work with that. That's what counts, and when the market starts, we have to be concentrated then on our strategies. And that's the next point, where I want to talk to you or with you about the strategy pattern execution summary. Some strategies I found they are working extremely well. What makes a good setup? I think there could be far more points than I've found. These are only few, very, very few points. You can add your own points to that, what makes a good setup. I think consistency is a good point to start with. When you are consistent and you say, okay, I'm trading only sweeps, for example, then you are doing this all the time. And you know now what sweeps are, how they behave. You know when to trade them, and you see also what is happening then. Maybe not every sweep is working as well, or it's going your way you are planning. Maybe you have to readjust a little bit. We talked about yesterday about the sweeps when they happen, and then they are looking for liquidity level below to come to a stop, or the liquidity stops the sweep. That I mean by consistency. You should find your own way, you should find your own strategy. And what I'm presenting here this week and what I like to discuss with you is the possibilities the market is offering us every day, the possibilities. And then please use your own style. Either you are trading yes or treasuries or NQ or CL or gold, whatever you are trading, it will help you to stay consistent with your strategy. The second one is the ability to clearly identify if it's working or not. To understand if this strategy is working for you or is not working for you. Or we all have two chances or possibilities. Now we can do it on paper. Paper trading is a little bit different because it takes out the risk. So you are riskless. You can test it maybe for 1, 2, 3 weeks. That's okay. But if you want to test it really, then I would like to suggest to use the micros, and that's really a huge advantage. Started this year, or it was opened this year by the CME, to use the micros. So test your strategy with the micros. Yeah, you won't lose a bunch of money if you are trading micros. Maybe only trade on 1 or 2 contracts to make secure that your strategy works. And by the way, again, every trading and everything what we are talking about here, we don't have a 100% guarantee that it works. No, we don't have it. We don't have it either in our life, in our real life, not trading. I'm saying that I'm absolutely sure works more than 70% of any other strategies you might have learned or you might have discussed or experienced. Having a close stop and a far target, that's what I would like, or that's my goal, because if you are going to think about this MAE and MFE, it's an excellent measurement for successful trading. If you are doing statistics with your trades, I'm sure you have it already in your trading style, that you have to measure your maximal adverse excursion and maximum favorable excursion. It's important to get these numbers, because when you enter too early, you have a high MEA, and when you're holding too long, you have also a high MFA. With the knowledge of this week and the knowledge about liquidity, about absorption, about exhaustion, about the strategies, it is possible, it is highly possible to enter a trade with the smallest possible MAE. High risk reward ratio, that means you have a low, but by that I mean low risk, high reward. And I'm talking about myself here, not about you. Patience. That's what is, from my point of view, yes, a crucial point in trading. The patience and waiting for the market that he shows his hand is the most hardest part if you're sitting around for 2 hours and nothing happens. Let's start with the sweep. We have talked about yesterday, we went through the exercise yesterday, we will see it today again. I think that the sweep is the most promising trade setup you can see in any market. It is harder to trade in oil. As we discussed yesterday, it's much harder to maybe to trade in very thin markets, although they also happen in every market. Think about to build a strategy for yourself with the help of sweeps. Sweeps are signs of liquidation and capitulation. See sweep chapter. Go back to the sweep chapter and go back to yesterday's recording again if you have to need to. Go to this and you will see that it's interesting to understand first of all what sweeps are, how they behave, what the matching engine is doing normally, and how we can work with them. As we discussed, it leaves always an imbalanced limit order book. This imbalanced limit order book means that it should be again in balance. As we agreed, and I think you understood it extremely well, is it must always be traded contrary. It must always be traded contrary. Don't fall in love with a sweep, or even don't fall ever in love with your trade. If it goes against you, kill it. Cancel it. There's no mercy. There's no mercy. Pattern, wait until sweep comes to an end. Does the market retest price at top bottom? Volume retesting top bottom must be clearly lower than traded before. Use divergences, ask bid imbalances or other indicators. Target price seeks liquidity, correlation to other markets. So it depends on whether you will get a huge profit out of the sweep or even a small one. It depends on the context where the sweep happens. And I will show you actually on, we can't replay, we can't go back, but let's talk theoretically about what happened today in the ES, okay? Let me go back to this event here. It was the open, the pre-open here in Europe, in UK, Europe, 8 and 9 o'clock AM. Given we are around here in the market and this happens here. Maybe you can even say, let me just scroll back. Maybe even you can recall the page of the presentation where we talked about that. What happened here? Based on that, what is in the presentation?
So what it's part, I think we can see a large spike to the upside.
Yes.
Also, the volume indicates that there was lots of transactions traded.
Yes.
But like at that time, the higher liquidity was much above. It wasn't. Yeah.
Absolutely. What we have when we're talking about sweeps, I know I showed you at least 4 variations of a sweep. The most common variations of a sweep you have in your presentation. Can you remember this sweep happens, then the next one, then the third one? We had a foil, and let me show you the foil. This one. Execution 4, trade into the sweep. Sweeps in a row. We talked yesterday about this variation because it happens more. Yeah, it happens not more than one, but it happens that a sweep happens, then normally price is retracing because at this moment there is no more energy to push the price further up. Then retracement, and then we are looking for the liquidity. Look here. What is happening? Therefore, I would like to motivate you, go over this variations and these executions because they are very, very common. Now, what I want to point to is high volume traded here, but the next is coming in, and the next is coming in. It is, how to say, it is kind of time. It is kind of experience when you see that. Maybe not to go against it. If you go against it, you got a fill here. You got maybe 1, 2, 3 ticks out of this trade. That's okay. If you can do that, fine. But have a look a little bit far away of this sweep and see that we have liquidity here around 15. In this case, 15. What's important here is we have a sweep, and then the price went up or goes up to this liquidity level, and that's always a good position. That's always a good position for selling or to go contrary against the sweep. Look again, what we are talking about is this one. The stops are very clear where you have a position here, which is in every part very extreme and very clear. Your risk is, let me say you get a fill at 14 and your risk is maybe here 15 and a half, 1.5 points. This is your risk because the stop must be here. This happened today in the European pre-session. And it was amazing to see that and to watch it developing against this liquidity. As said, you have a low risk. This is this variation. You have a low risk and a good entry point. By that I mean, if you are translating this into your measurement, you have a low MEA. Excuse me here. This case, you have a low MEA, and that counts, and then it depends on where the market is going and what happened. So let me see. Anyway, if you are in, you think this is a good point to exit. These are 6 points, for example. Great deal. Close your PC, enjoy your life.
Walter, I'm a little confused when you say based on the experience of looking at these sweeps and not going against them. What specifically are you looking at?
In this case, I'm very clearly looking for this liquidity above. I don't...
Okay. So if you see that liquidity above, you sit on your hands basically with these sweeps that wait for them to develop?
Yes. Yes. In this case, absolutely. The general rule is go against the sweep. This is the general rule. If this is general rule, then we have to make some exceptions because sometimes, and that's the bad message, sometimes they are working absolutely accurately and we can rely on them, and sometimes not. That's the point. You could take a short position here. But why should you take a short position here when we have liquidity above here? That's the point. If we have liquidity above, then look and be patient to see how is the price reacting on this liquidity. We have energy loss here. Let me say energy. As said, you can find your own expression for that. I'm saying the energy is lost here and energy is lost here. And then everything what happens after this huge volume bars is a divergence. It's a nice and good divergence. Let me draw this in here. Here we are talking about this one. And then maybe you should make a rule for yourself. The first general rule is we are going against the sweeps. First one. The second one, if we see long-term high liquidity or short-term high liquidity very close to this area like we did yesterday, because the sweep yesterday, so far I know, in yesterday's exercise, in yesterday's exercise went very, very sharply down, then it goes up, and then we had liquidity here. Let me think about that. We had liquidity here, it disappears immediately, we had the last liquidity somewhere here. And that was the area where this sweep or this move comes to an end. It traded around this liquidity then and then lifted off for 10 points or whatever. That was the situation yesterday's exercise. I think it was Wednesday, if we are going back and look at the Wednesday sweep. So where that happens and you have liquidity below or above, in this case, wait, see what is happening. As said, it is a kind of your daily experience. You can make your rule, say I'm going against the sweep. You have the chance to, let me say whether we can find whether I have a good example here. Whether I have a good example here. No, I don't have an example. You see that?
Walter, if you go back to that screen, the thing that's really amazing me with the sweeps is if you look at that level where you went down just after 12 o'clock local, where you swept down, and you look at that price level at 07.5, give or take. Yes, right there. So look how we swept down there. That became support and resistance. We came up. And then just recently, that was another area that was capitulating around 07. And if you look at, we still have yet to come back and say repair that sweep.
Yes.
Last sweep up at 07.50.
Yes.
And look at where all the liquidity came in. Well, actually, we did repair it with this last down move, but it was really interesting to me to watch liquidity come in and around these areas where sweeps started.
Yeah. Just a moment. You're talking about these areas here.
Yes.
The sweep happens. Yep. Let's say these are gaps here, and I would like to use your word. They are going to repair this one because this is broken. Sometimes it takes time to repair this one, but look here, we have the same situation here around 07, and it wasn't repaired so far. Let's see how this works. I don't know what this is around now. Maybe some.
Yeah, that was Canadian news that came out, and
okay.
It actually basically did a high wave candle on the 1 minute basis.
Okay, good. Anyway, yes, it is amazing, and you will see this behavior all the time. When you experience it, this is only one variation. There's only one variation of trading possibilities. But if you are concentrating on that, you will see that they are going to close all these holes here around these sweeps. And in this case, it would be a picture book trade when they are sweeping and going back to this level here, and that's our entry here for long position. So that means we have in the pre-session maybe only 4 points, 3-4 points here, but this should be our entry. We're on low volume. That means we have also divergence here, and this should work this way. This is the classical. This is the absolutely classical. We have some variation as discussed, or seen this today on this side after the Open, after a European Open here. We have sweep here, and they are going towards this liquidity at 15 and then drop back. It is an absolutely secure trade. It's pre-session. It's not maybe suitable for US colleagues here because you are still sleeping here. But in the pre-session for European traders, this might be extremely good trading because there's there's less volatility than after the session start, of course, and it goes down. It takes time, of course. Look here from 10 to maybe 12, 2 hours. It doesn't matter. When you are in profit, you can sit back and wait until your target comes in or your targets are hit, whatever. It's fine. It's a fine trading. So without much volatility around. And thank you for your comment, George. That's absolutely true. Everything is going to be repaired. So even if we have some enthusiasm here on this level, price is dropping back, we have still this 15 area above, which is very interesting, and as well the 19 area. On the lower side we have the 04 area, and we have this strong 88 area here. Coming back to the executions, let me find the page. Yes, sweep contrary trading. We are always against the sweep. And please keep in mind again, I would like to stress this. There are several, let me say, 4 variations of sweep. And please go through them thoroughly to see how they behave, what is happening, to build your own strategy around. And I would be happy, and as well the colleagues, all colleagues would be happy if you can and would share your ideas, your comments on your strategy based on this, on the sweeps. This is the classical one. You see, we don't have any, they swept through this liquidity, and we have any important or market or whatever liquidity above at 83 here. Nothing. And that's really the classical. Absolutely the classical here. That's the best one. Even if it goes a little bit further, let me say maybe 1 point or whatever here to 83, it doesn't matter. The energy was on the way, was lost here. The energy was lost here. And in normal times, this is going to retrace and to go back then. And you look here, this was a trade for, yes, 10 points. Straight down. That's you and my dream, that's our dream here. To enter this with lowest possible MAE and get the maximum, the highest possible MFES. Yes, that's the absolute dream. When you experience that one, you will feel like God, really, believe me. Yeah, pre-session trades are great, yes, of course, because you are more concentrated, they are not so volatile, and they are easy, when they work, they are easy to handle. But you will feel it, and that's a tile of our psychology. When you enter this trade here, you got it. You understand what happened here. You understand that this is your entry area, and it goes immediately within a few minutes. I think 5 minutes, 15, maybe 10 minutes. Not more than 10 minutes. You got 10 points out of the market. Believe me, you will be the greatest guy on this planet. The greatest guy on earth. Don't fall in love with this feeling, because that's the wonderful part of trading, that when you understand what is happening, you enter your trade, it works in your favor, you get out 10 points of the trade, you are the greatest guy of this world. You can do anything. You know, nothing is like you on this planet. And conserve this feeling and keep this feeling with you, because it's good to have positive feelings out of the trading. And if you do this several times, and you have the luck, or we have the luck, that it behaves like we discussed in theory here. The biggest danger is not the biggest danger then. That's my experience. Not that this is not working anymore. It works every time. We have some variations around that, but it works every time. The highest danger is not trading. The highest danger are yourself, because you think you are the biggest. You found the holy grail, and it works every time you weigh. That's the most dangerous part I've experienced myself. be humble. it sounds trivial. It sounds really trivial. But be humble and forget this trade. Calm down. Go for a walk. Enjoy your success. But stay with your feet on the earth. Stay on the floor. Don't take off. Don't take off every emotionally, because it will work. I'm sure it will work. But don't take off. Stay humble. Stay on the earth. Stay on the planet. Stay on the floor. Because you will experience also days where it's extremely hard to trade. Really extremely hard to trade. Okay, but anyway, it works. Let's take another one. That's what, and it's not the same one, but it's similar what we have discussed yesterday. You see this brutal sweep here. This holes here, these gaps must be repaired. And that's a good point here. We will see, we will talk about time in a moment. They need 13 minutes and nothing happened here. Nothing happened. Excuse me. They took 13 minutes here and they didn't sell it. They didn't sell it further. If the market takes 13 minutes not to sell anything, then be aware. Selling happens in a very short period, very short time period. So if the market is not willing to sell anything here, at least in 20 or 30 minutes, therefore I'm insisting to take the time into your consideration as a trader, then it is highly possible that it's going to lift up, because we consumed everything, energy was lost here, and it took new energy to put the price, to put the market further down. But that doesn't happen here. Not here and not here. And look also in the limit order book. I know that the dome reading is not convenient. It takes time. It's a little bit weird, you know. All these numbers, I'm not comfortable with that. It's not convenient. I have to think a lot. And that's what I said with, if you are going to read this book from Daniel Kahneman, then you will understand that we have two systems. And the system 2, which needs time, energy, and logic, it's a bit uncomfortable, you know. It's not so where we feel really relaxed and easy. No, it's not. But it's the better system. It's really the far better system, because you are going to make better decisions for yourself, not only about investing and trading. It concerns our whole life. We have the same here. What is this? This was the sweep. This was the retracement. This was one from November the 14th. The same behavior. I think my idea with this chart was to show you the sweep. We have to go against it. Either we catch the move at the top, a little beyond this the top level, or we are catching the move somewhere in between here. It's really hard to say or to get it. And then it developed from 94 to, let me see that, 89. There are leaving imbalanced auctions along this move here. They have left imbalanced auctions or low volume nodes or gaps or holes, or however you want to say that. I would like to prefer low volume nodes or gaps. They are going to repair them. Until 90 or 89. That's really impressive. It happens more than often that you will see that all those where the move starts here, where the ignition starts here at 91 here, they are going to close and repair all open price levels here. That was the idea. And the second and last one I would like to see to discuss it with the sweeps is when you see the same behavior in NQ, in YM, and in ES. Therefore, I would like to say, if you are going to trade this system or thinking about to make your own strategy around that, then please put on your chart the NQ, the YM, and the ES. When they are in sync, when they are bought in sync, you can easily see where the liquidity areas and liquidity areas here. Everything goes hand in hand. Nothing works in isolation. Everything is connected together. So if you want to understand why this is happening here, then please look left and right on your charts, on your PC, on your monitors, to see what is happening in other markets. It will give you the confidence that this move here is over, because there's a strong liquidity there and there's a strong liquidity here. And we have also good liquidity at this 1175. Again, everything works together. This seminar this week is about to show you that you shouldn't look at a single chart, but connect every possible information together. Not too much, but when you see that what is happening here, for example in this case, it's going to amaze you and to make you confident, in your move, in your trade here. Yes, Tom. And QNS in YM are in sync, great trading. Absolutely. Let me show you. Maybe I can find it. I haven't had a look here. Oh no, Apple is not open here. Let me have a look at NQ at 10 o'clock my time. Yes, you see that here. This is the equivalent to, where was it? I think it was here, to this one. There's this one, you see that? And let us have a look at YM. It was not so clear in YM here. It was not so clear in YM. But anyway, in the YM we had, and in Dow Jones Industrial we had a large volume also here. And Q was very, very clear what is happening here. Look here at this liquidity here. It was where is it? $237. It's a huge number for NQ. And then finally, let's have a look at the treasuries at 10. Maybe we can see also here something or not. They jumped up. By that, by meaning when they are jumped up at yes, is what it was around this time here. When this is going up, when the treasuries jumped up at the same time, this is a divergence. Guys, this is a divergence here. We had the divergence in the treasuries, and we had a jump in ES and a jump in NQ. And suddenly they are coming to an end here. Good visible here around 83.10 in the Nasdaq. Let's see the yen. Also the yen jumped up, and you see that when yen soars, when yen goes up, US dollar, When this is happening, then that means that the market is, ES market is likely to go down. This is a divergence, this is a contrary trade. Now we have a good sampling, good correction since 1 p.m. my time, and now the yen is rising again, maybe against this level here. And if this happens, then be sure that ES is going to be sold. Here. Now we have a good idea what to trade and how to trade, and to build our strategy around. What happens if we do the right preparation? We know the market is going up. We see that that Apple and Microsoft and the SPY and NQ and YM are rushing up, for example. I would suggest, and I'm doing this because it makes sense, I'm calling that the rebid or reoffer. Rebid means to enter the market and to take advantage of its direction. Pattern, you get a bullish market, liquidity above attracts price. Step in and rebid the move. Target is liquidity above, or liquidity, yes, above the move. Stop below last low, and you have to be aware that the risk reward ratio is not optimal in this case, because look here, the market was pre-open a little bit sideways, but we had enough information in the preparation that the market is likely to go up and to trade up. The question is, really it depends on you, on your trading style, whether you want to rebid and don't wait for 1 hour, 2 hours until the market is hitting this 3000 level or whatever level, or this liquidity level, because it's very clear what is going on, 97 to, and that's our target. This is our target area here. It's very obvious. We don't have a sweep, we don't have anything else around, but why should we miss this move? Why should we miss this move? Let me show what I mean in the prep section. Is this one. Market starts somewhere here. We don't either revamp, we don't have a POC around, but the market is bullish in our case, and the market is going up, 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 up. Now we have the chance to wait, but on the other side, I would like to be a little bit more revolutionary, you know. Why obey why obey sometimes? Step in and go with the market. Maybe this is a bit strange for you now, but I would like to mention it because it's fair to mention it, because it happens very, very often. So I'm calling it rebid. You can call it step in. Now we know following. We have green dots here. That means the buying pressure is there. You see it very, very clearly. And we have an anchor point here. Anchor point here and anchor point here. So that means if we step in, maybe our risk-reward ratio is not optimal, because we have to find a little bit lower stop, not lower, but a little bit larger stop here. And then we are looking for the 301 area, or this area here above. By that, this is my expression to, if you want to trade, you did your preparation work and the market is going clearly up, why shouldn't you join, or why shouldn't we join not this move up to there? Because we know one, price is seeking liquidity. Always. This is acting as a magnet. So we put this one in your trading strategy too. As the same means for reoffer, means to enter market and to take advantage of its direction. We are talking about bearish market, fast price action mostly at the beginning of trading session. Liquidity below attracts price. That's always, this is a golden rule. You must write it on the wall or put it on the paper, on your table, wherever you want to have it, but liquidity bill attracts every time the price. Step in and re-offer the move, market or limit. Target is liquidity below. If no liquidity below, ride the move until exhausted, maybe in a sweep. Stop above the last high, and the disadvantage is that the risk-reward ratio is not optimal. On some days we see a sell-off. We simply see a sell-off. Jump on the train here. Your stop must be a little bit higher, so you have a higher risk. But if it works in your favor for 10 points, nach 8, 9, 10 points, whatever, you are in. You are in. The next chance you will get is this 430 area here. It is a sweep, you see that? With a retest of the sweep, this is the classical, and it goes up against this level here. I think it was my trade here so far, I know. Yeah, I think it was my level here. My entry, my trade here. An extremely important point is that we have to use time and liquidity as an indicator. It's absolutely reliable. Maybe we are not used to work that way. Maybe we are not used to work that way. But as I said, time, price, and volume are the trinity of trading. And time is the most underestimated factor in trading, or in other words, time or timing is the most important factor in trading. You have asked 2 questions this week. Or we have discussed these questions this week: is where and when to trade. We have answered the question where to trade. We have several opportunities to find the answer to the where question. But the other question is as important as well: when. So both comes together when we have a classical in the sweep. So we have a sweep up and then a retest, and then it goes down. Then we can answer where to trade and when to trade. When is answered by the time the price retests the high, for example. To illustrate it, we have a sweep here above, and then it takes time to retest. That's T. We have the time. And now we have an entry area for the classical, and it goes far away. Maybe it repairs all the gaps here below, and we have a nice trade within a short period of time, if we take this as time here. Okay? Price seeks liquidity, that's obvious. Pattern, we have a bullish market, firm support at price, liquidity attracts buyers above, execution buying dips at retested price level. And target is liquidity above. Draw a rectangle around retested price. By that I mean following. You will see that very, very, very often, every day. It happens most maybe after the lunchtime New York, Eastern time, for 1-2 hours. And then it finds the way up to the next liquidity level. You will see this. It's only one example I've put here on the chart. I'm sure you will see that in oil, you will see that in every other instrument, that sometimes the markets simply need time. Either they are out for lunch, for example, or the market waits for announcements. Think about the Fed announcement, and maybe also in the evening here that someone is speaking and the market waits simply. Don't leave this opportunity untraded, because it's so simple to trade it, really. You see the time? It started here, went up 2 points, comes back, went up 1 point, and so on. You will find this pattern extremely often in trading. So think about the time as an indicator. It's absolutely important. That was 4 p.m. my time. That means it is, what is this? No, 10:15 Eastern time here, 10:15 Eastern time. The price traded for, what is this? 3 points for 1 hour. And suddenly you see that they are supporting the up move here. You have enough time. Draw a rectangle and find your entry maybe here at 86 in this case, and the stop is absolutely clear definable. It must not go as below this 84 area here. If this rectangle is broken, then something is wrong, something is amiss. You are out of this trade and wait for the next opportunity. Maybe this is really new to you, but you will experience that because now you might recall when you are in trading, oh, hey, there was a guy, he told us something about the time, and I see this one, now I'm sitting here around for half an hour, and the price is coming back into, oh, stop, look here, this is liquidity coming up. Let me draw a rectangle to better judge what I'm doing here, and then, yes, clear, okay, the next liquidity is up there, I have good support here, then find an entry here. It's a little bit uncomfortable, this area, because it takes, yes, 30 minutes, 45 minutes to lift off. Pullbacks, we talked about pullbacks. They are happening in trending environment. Pullbacks or reversals always happens in a trend. Move ends in a volume flurry or large volume cluster. Absorption of the volume happens, that means loss of energy. Covering or profit taking starts. Pullback ends in depleted volume, that means exhaustion. Divergence in chart accumulated volume profile, and this is a good short term. We should find liquidity and good short term high liquidity above or below the volume cluster. That's the classical. If you didn't join this move from the beginning on, or somewhere in between there, if you miss this one and it is not very clear what is happening, so you miss this one, then wait until you get a nice pullback. You got a pullback here, small one. You remember when the volume is absorbed with a heavy volume around in liquidity, this liquidity disappears. This market makers or market players are out of the market, and then it pressed the price down here. This is a small pullback. Join this one and go. If you miss this one, then you will get another chance, maybe a second and a third chance, if you are patient enough to get a short again. This is a classical pullback situation. We have a strong down move, an absorption. You remember this small correction, the small pullback. Remember the small pullback here. And then what happens is simply, if you miss this one, don't force anything, but wait until you get a nice reversal until this area. You will see this often that happen. Down move, pull back, short covering or clearing their positions, and a new liquidity is coming up. Especially here, you see that liquidity came up, business done here. And suddenly they are coming back and hitting this 33 area again. This is the best chance to go short here. when you recognize this. Just an idea I've got last week. I think it was last week. When was it? Never mind. Because to say there was a sweep and the reaction of the sweep comes later on. They are trying to close the sweep, and you see exhaustion here also as well. And the reaction of the sweep, when it detonates here, it takes time for the waves to spread out, and you see the end wave here, and it's going back down to correct the sweep. Let's go to the strategies indicators part 3. By that I mean, let's talk briefly about that, what bookmap is providing or offering, so that we can understand maybe how to set up bookmap and what to use in bookmap. Indicator I'm personally obey really every day. That's a VWAP. Because VWAP is the ratio of the value traded to total volume traded over a particular time horizon. It is a measure of the average price of financial instrument such as stock or future traded at over the trading horizon. The most professional brokerage firms offers what is known as guaranteed VWAP execution to large institutional clients. Guaranteed VWAP is the process of executing trades exactly at the VWAP price. We are using, or we can use, the VWAP to identify liquidity points. VWAP spots the action of very active money pools. Please use VWAP every day in your trading. It is a non-GAAP indicator because it is calculated on the volume, on the traded volume. It is so important on some days. You will see that distribution, for example, happens around the VWAP. If this happens, you have to watch it. If the price is below the VWAP, then mostly then we will have a negative day. If the price is above the VWAP, most of the time we will have a positive day. Now when we are talking about VWAP, we are talking about daily, weekly, monthly and time-weighted average price. Maybe you know that, so I don't want to waste your time with that. That's the daily VWAP. I'm using the indicators for wizardindicator.com for Ninja Trader. I'm sure every single charting system has its own VWAP. Then we have the weekly VWAP, the monthly and time-weighted average price. When you go into your bookmap copy, then you will find the VWAP settings into the studies configuration, into your studies configuration. So have a look here. Please set it according your time. The session start at my time is 0 a.m. and I think it is 6 p.m. Eastern time. This should be, yes, this is the normal settings. It shows the VWAP correctly. It should have the same numbers. Where's the VWAP? Here's the VWAP. This is the VWAP here. You should have the same numbers on your chart as well on your bookmap chart here. The only thing you have to have in bookmap is you need the full session data. That means you have to have a subscription for historical data. The session starts here. That's 6 p.m. Eastern time. In Europe time, my time is midnight, 0 a.m. It makes sense to start the VWAP right here at the session start. That means 6 p.m. Eastern time, and your time, wherever you're living. Please set it accordingly, because then you have the most accurate VWAP available for the day. And have a look here. I think we have some good indications here. Let's switch off this one here. And then look how the trading was around the VWAP, and very often you will find that the price trades around the VWAP for 1 hour or for a longer time than only 5 minutes. You will see that. Look here, dropped off the VWAP. We have a lot of, by the way, we have a lot of VWAP trader out there in trading. So there are a lot of VWAP trader who are looking if the price is touching VWAP, then they trade. This depends really on. I recommend using the VWAP because it's a really extremely important indicator. It's already there in the bookmap copy, so your bookmap license. Maybe it's sometimes so that we find a bottom, and when we find a bottom, the VWAP is somewhere around here, maybe together with a point of control, and then the price is likely, very likely to go against this VWAP and point of control. Please use it. Look here what is happening. Next is 94. Absolutely interesting to use the VWAP and put it on your chart. It doesn't hurt you, it helps you to understand maybe what the market is doing and where the market is heading. There are a lot of examples. You will see that every day. And sometimes when we are talking about our strategies and observations we did this week because of liquidity, absorption, exhaustion, book flipping, spoofing, and so on, you will see that sometimes you have the VWAP, the price is going up, you have the VWAP, and you have decent and good liquidity around these areas here. When all this come together, you have here exhaustion, VWAP, liquidity above. It's a great help to understand what is happening and what to trade if you want to trade that. You also have it on the chart. Look here. Most of the time they are hitting the VWAP. Let's talk about the bookmap and its advanced applications in bookmap, which could help you to understand better what the market is doing. Cumulative volume data we talked about, iceberg detector, large lot tracker correlations, alert settings, APIs. The CVD is a very basic indicator. It simply plots the accumulation of aggressor volume. The CVD simply displays the cumulative volume of buy aggressors minus sell aggressors. Buy volume is a positive number and sell volume is a negative number. Add them together and that's your CVD output. So if you buy 5 contracts and you sell 2 contracts, you get +3 in this case, and if you sell another 10 contracts, you get -7. That's very, very obvious. So in your bookmap, you have the y-axis values here, displayed by the thin white line. You have the historical output here, and you have the CVD widget that's displayed here. So these are the widgets, or this is the widget area, and this is the y-axis, the numbers of the indicators based here in this area. And you got the, let me show you only the CVD here, here. So this is the CVD, and this is the cumulative volume delta. And this is the very basic one because it is based on simply calculations of buying minus selling. By the way, what was this one trade? What kind of trade was this here? Yes. Now, let's see whether this works out. This can take a little bit time. This is the next area here. Good.
So this area right here where they're trying to support, Walter, this even quarters, notice how that's where the last time they came down and it looks like they took them out. And then is there buyers in here? Is that why we're seeing this short-term liquidity come in on the bid?
Yeah. Now they are trying to support this one. Let us stay a little bit with this trade here, because they added 538 at even here. 31 even.
That was an older level, right? From earlier.
Yeah, this was this one. Yes, absolutely. But they broke it first, and they're trying to. Yes, they're trying to protect this 3100 because this is a psychological level, but they broke then. So first of all, they are adding 500 at this level, and if you look at the quotes delta, they are trying to push the price up here. You see that? They are trading 500, 600 into it. And by the way, we are coming now to your question yesterday. Look, they are selling 600 into one even here. 600, they resist, they're trying to add, they're trying to resist, they're trying to buy everything they are selling into it. The question is, do they have the breadth to resist at this level? That's the main point, that's the main question here. I've got it. Yeah.
So my question here then, Walter, becomes the hierarchy. So 94 is still the number one hierarchy. Since they came in here at evens, does that change our mind at all?
Yes and no. This is still on a valid level. It can happen. Look here.
Oh, they just pulled.
Yes, look here. What happened? It can happen, and that's what every one of us will experience when you're working with this kind of market view. You know, you see here really what is happening. You can't see that in any other chart. When you are looking at that, then we are talking right now at this psychological level of 100 even. That I think we had 530 on this level. It was the same level like here. Then there was hit. Then bring the price up, and then they are suddenly cancelled. I wanted to say this would be my priority one liquidity, because it is there since the start, since the session started at 9:30 Eastern time. And now the pull, you see what happened here. Maybe I'm sure they know exactly what is going to happen. They want to be hit here. They want to. They are bidding. So the danger, the jeopardy they are in, or the danger they are in, is that they are bidding, and suddenly a big sale comes in, and they are still in their positions, and they want to go long, and the market is further down there. Maybe we are not talking about one contract here, maybe 50, 60, 100, 200, 300 contracts, and that's a lot. You see that? I wanted to say that when you ask, this is my priority, my first priority, and then we have to see what is going on. You see here exactly good, extremely good, how they are pressing into the sellers here. They're selling at, you see, 200, 300, 200, 300. Now they changed a little bit. That's normal. When they resume, they are starting again 200, 300. You see these numbers here. This is an indicator, like a gauge or like a dynamic bar, which is going down and down and down and down and down, pushing down towards the 30.94. Maybe even below this one. But this is now becoming a possible, really possible target here. Let me talk about this one. I've got an answer. Conditional resets. Let me show you that. Conditional reset, let me find the answer. Reset level based on aggressor. This is very clear answer there. Reset bid volume only by bid aggressor trade. That means when the aggressor changes his side from buy to sell, for example, then the condition is true, or the condition resets. So reset level based on aggressor means when the aggressor changes his side. It means when he goes from buy to sell, or vice versa, of course, from sell to buy. Then this is one condition. The second condition is reset time level if time between two events, and the developer wrote between two consequent events. Two following events on this level is more than 1000 seconds or milliseconds and 2.5 milliseconds. That means that that means if more than 1000 milliseconds passed since last trade event. So when they are traded, nothing happens. But if there's no trading for 1000 milliseconds on that level, then this becomes true.
So is that on one price level, or is that the ask bid spread?
No, this is for each price level. This is valid for each price level. They are trading now this 75 level here. They are trading now 75. And the reset happens when within 1 millisecond when they are trading, nothing happens. So that means we have we have 432, and there are two conditions defined by the conditional resets. Is when 1000 milliseconds, that means 1 second happens and nothing is traded more, then this 434 becomes 0. Or end, I'm not sure, or end, when an aggressor changes sides within this time. This is so difficult question, George. You ask.
So I understand this now. So if you want to have the conditional reset based more on the aggressor, then you would want to increase your milliseconds.
Yes.
Because I would assume that the price change is going to happen more often than the aggressor coming in.
Yes. Yes. Yeah.
So you'd want to set it to 5,000, which is basically 5 seconds.
Yeah, but that's
too. Really wanted to show the aggressor.
When we are talking about the treasuries, I would for sure set this time at least to 5,000 milliseconds. So it depends on the instrument traded, because the treasuries needs a lot of time to move. Let me show you the treasury. Excuse me, just a moment. So because the treasury here, the ZB, 30-year bond here, takes a lot of time, because they are moving one fraction up or down. Then I think this would make sense to let it to define 5,000 milliseconds, because in this case I haven't tested it. I'm not sure, but I think you have more time and you have a more accurate indication what is really traded during the time here, during this time here. So this is one point I would like to set this with the treasuries here, and with very fast instruments like yes, maybe, or even ES here. It's 1000, it's okay. I'm not sure whether 2500 it's okay. Maybe we should test this. So find your own time.
So Walter, inspired. Would you be able to talk to us about the last indicator? You see this CQC indicator that you have on the right hand side?
Which indicator?
Well, it's not the indicator, it's the ladder, yes, on the right hand side, maximum to the right. If you go to the right, it's
The quote center here. The quote center. I have put on the side on this on the presentation this link. This link is from my colleague Bruce Pringle, and he described in few minutes features and components of bookmap. And one of these features is quotes counter practical use. This one.
Session accumulated as SQB or exit. Click chart range accumulated.
This is mainly about how to set up, but go through it. But I don't see any useful practical application for my trading in watching the quote center. So maybe you can correct me, and I would be happy to learn about that. But I don't see any practical information about that one because I can't find anything, even if it's showing, even if it's showing the quotes and the quotes levels. Where are the biggest quotes, for example, here above? I can't find any practical application for my trading. So I'm back. CVD is absolutely clear. You see the mechanic of the CVD. Yeah, CVD indicates divergences. I think it's absolutely obvious to you and to everyone who is trading with a CVD that you can indicate sweeps. With this sweep is a 90 move degree. It is also displayed in the CVD part. You see that? High liquidity, the CVD happens. It is straightforward, a 90 straightforward line and a 90 degree move here. In higher time frame, you see how they are creeping up and buying and buying and buying. You see divergences here. So it helps you to... This CVD is of course easier to spot and to view than the quotes counter. And also if you have absorptions, you can see that with this small moves. So it's up to you to decide either to use this default CVD, or maybe you are looking for external indicators like sharp delta to use for your trading. Then here, this case, exhaustion. You see also exhaustion, what we talked about. It's a clear divergence. It's heading up through the liquidity and coming back to this level, exhausting, indicated by low volume here. I think this is, after this week, an absolutely common understanding about this function. The iceberg detector is one of sure interesting parts of every trading, because I mentioned this week that what we see here in the book is only a part of all contracts traded. It's only a part of all contracts traded. That's especially when you look at, let me see that, at Amazon or Apple, or you see that how they are supporting the S&P here, Apple. Absorption, and yet then when you have this chart on another monitor, you can really be sure that this, let me extract this chart here. Oh. Now look here, when I use the crosshair, you can compare wonderful where the absorption happened. We had this psychological area around 30 100 here. It dropped down to 98, and look how impressive it is to understand the correlations between the markets. It's only one example. You will see enough examples all day long in your trading. Guaranteed. Absolutely. Iceberg detector. So what I wanted to say in coming back to our presentation is that this is only a part of what we see. Bookmap generates the iceberg indications based on difference between the actual pending order offered at the price level and the actual number of orders that transacted at that price and at that specific moment. Larger players use hidden orders to icebergs to conceal their intent to trade at that price level. Their large limit order do not display in the limit order book. Therefore, these hidden orders do not skew the auction imbalance. Absolutely important to know. We should keep this always in our mind. Can act as absorption at that price level with lack of liquidity in limit order book. So you see that. You see they are hitting constantly. Or the price. This is hidden. You can't see that. You can't see that on any of those or similar charts. It's impossible. It's impossible. So it's absolutely imperative to a paramount to know that these iceberg orders don't skew the book at the first moment, but they can absorb everything on a certain level, or they can hit the bids or the asks, and then the price goes away from this price levels, of course. Yes, this was, thank you. This one here. Look here. This is an algo, but this also can be iceberg orders hitting constantly into the 55 something, 55.40. It's not visible, but it should be obeyed. You should keep it in mind that these iceberg orders are there. They are hitting the book constantly. We don't see that. We have a function in the bookmap where they are counting the iceberg orders, but it's really different. So I'm using rhythmic, and as well I'm using the X feed, and the numbers are different. There are numbers where if you compare rhythmic and the X feed, they are a little bit different here. So I'm not really sure what numbers I should use and what to rely on. It's great. It would be a great indicator, but anyway, I'm trying to show you the practical application of bookmap trading, of limit order book trading, and I'm trying to show you to put all these pieces together to get an whole picture and holistic overview and holistic overview, not overview, but a holistic view of the market. And when you have this, you can better and trade with high confidence, with a high probability. But it is really hard for myself to use these numbers, to incorporate these numbers in my trading, to include these numbers in my trading. It's really hard for myself. So should I buy? Should I sell? Yes, we have more green than red on this side. That means this could mean that we should go long here. But to be open, I'm obeying every iceberg order. I know what it is, and I'm looking at the limit order book to see where absorption happens. Absorption can also be a part of iceberg orders. We haven't talked about finished auctions. Finished auctions happen out of nowhere. You see no liquidity here sitting, for example, but a big and large dot. And I'm sure that this big and large dot is hit by iceberg orders. It's a kind of absorption, and then the market drops back or goes down here. The usage of iceberg orders is as described here, that the indication of iceberg orders show you that something is happening here. That means the market is likely to drop when they are hitting constantly the bids. But anyway, it's there. You should know about the function of iceberg orders, how they work. From my point of view, really hard to spot what is really going on here. And it depends, and that's the second point, maybe the second disadvantage. I have different numbers with Rhythmic and I have different numbers with the X-Feed. If you are using, for example, other data providers, you will have as well other numbers. So which number is reliable? What is the right number? Large lot tracker is an extremely helpful. It's an extremely helpful function in bookmap. It is an approximation of the largest single pending order at a price level if that order crosses a certain threshold based on the adjustable settings in bookmap. It's an approximation of the largest single pending order at a price level if that order crosses a certain threshold based on the adjustable settings in bookmap. Larger players typically set individual large blocks orders in areas they want to deal, can act as a spoof, purposely showing large orders can skew the auction, and cancellation of these orders can create vacuum. So you see this large lot trackers are indicated by this small vertical lines. Small vertical lines. Let me see whether we have here some. Yes, here below that one here. It depends on your settings. It depends on your settings here. Large lot tracker, you can set a percentage. What do you want to see? The lower the percentage, the more vertical lines you have. I think we had some examples this week where we have really large volume and 1000 something like that, and then it is indicated also that maybe one institution, one large guy is sitting there. You see this 699, there's a vertical line here on this 94 level here, still active, and that means there is a really large institution, large guy here, or a big guy with enough money to absorb this the contracts here at 94. Absolutely helpful. So if you want to use it, if you have it, put it on your chart. It helps you to get a little bit more overview. Order book imbalance. Order book imbalance represents the ratio between the average bid order book size versus the average ask order book size. Volume imbalance represents the ratio between the volume generated by buying aggressors versus the volume generated by selling aggressors. The two imbalance indicators are calculated according to the current chart range. Any change of the chart range will affect the readings of the imbalance indicators. Alert setting is quite helpful. It alerts you when extraordinary imbalance in limit order book happen. Be careful in area with many imbalance alerts. This is my practical advice. Imbalance areas, it indicates pause, end of a trend, or reversal of a trend. If you're working, or if you have a footprint chart, whatever footprint chart you have also a kind of imbalance indicator in your footprint chart. It means 804 versus 343, or vice versa, 84 versus 54 versus 116. This is an extreme volume imbalance. You can set this volume imbalance in order book imbalance settings. So the price range of imbalance computation is first 10. That means I'm looking for the last 10 price levels. That weighting the last 5 levels more than the remaining levels. And I can also enable the sound. When the imbalance is bigger than 99% of both sides, of either ask or bid or ask, then I've got an
example. Bid imbalance 15% at yes.
Then I've got then I've got an alert, and that helped me to see or alert me. Okay, guys, something is wrong here. There's an imbalance in the chart or in the market. Be very careful. It is really helpful, guys. So please, if you have the plus version of bookmap, use it. Point of control is obvious, I think, for everyone who knows what volume profile is, who learned the volume profile. It's a common usage today in trading, and I recommend to understand what volume profile is. Read James Dalton, I think it was. He wrote a lot of good books around volume profile. Or Dr. John Kepler, for example. James Dalton, Mind Over Markets, or Kepler, Profit with a Market Profile. I recommend it highly because it is every time of an interest and help to understand the point under the volume profile. The point of control, commonly abbreviated as POC, is a market profile term which describes the price level where the most volume was traded. A naked point of control, also called a virgin point of control, is a previous POC which has not been traded. It remains active until it is traded or taken out. For this reason, it attracts price towards it. The further information you will get in these books. If you have a chart like, let me see where it is. Oh, no, this one. Then you for sure know what a volume profile is, where the volume profile is located, the naked volume POCs and the last POCs and the past POCs, the naked, the virgin, whatever you want, you can get it on your chart. You can also use this POCs as a marker in your bookmap chart. Maybe they are coming together with liquidity. So it's always good to know what volume profiles is and volume profile is and what a POC is. This is the setting. It's very clear. Bookmap APIs, I don't want to comment this, but you can write an external indicator and you can add it to Bookmap based on Bookmap's APIs. They are open, they are described in Bookmap API Wiki. Follow this link, please. And there's a Bookmap forum. You can find a lot of useful information about Bookmap's APIs, application program interface. So on further bookmap features and components, I've posted in the chat here, and as well you find it here on the documentation. Bruce Pringle, a great colleague of me and the main educator from Bookmap, it's compiled a lot of functions and how to set them up. If you want to go through them, please go see this guided videos on YouTube. They are very helpful to understand how to set up further functions in Bookmap. Now we are coming to the end, but let me tell you, if you don't have the right data feed, and we talked about this week, that a data feed is absolutely important, that you have a high quality data feed. Please think about that. If you have CQG or DTN IQ feed or similar Kinetic or whatever, these are feeds who feeds you with only 10 or 15 levels of price data, and this might not be sufficient to understand or to get the whole picture of the market. Of course, Bookmap can be connected to multiple data vendors, and the quality of data feed differs dramatically. It's a huge business to provide data, but the quality of data, good data quality, costs money. Really, it is It is, if you want to have the best data, you have to pay around $1,000 a month. We are talking about around, roughly saying, $1,000 a month if you want to have the raw data from the exchange. It works if you have the money, if you have the resources, do so, because then you have everything what you need. Better data, you can't get better data. There are two differences of market data: market by price and market by order. Market by price describes a price-based data feed that provides the ability to view the total size of all orders at each price level. Market by price can describe either full market depth or a limited number of nearest bid and ask price levels. So you got either 5, 10 or 20 or 15 price levels. Market by order describes an order-based data feed that provides the ability to view individual orders and their evolution. The order's information contains its unique order ID, limit price, size and its location in the queue. Market by order typically provides full market depth, describing orders at each price level. This is the more modern and more transparent type of market data. Also follow the link, and also I highly recommend to read the CME Group documentation about market data. Absolutely mandatory if you want to rely your trading decisions on high quality data. There's a bookmap entry as well. Please go to the CME Group and to the description NDP protocol and market data here at this side. Absolutely helpful. This is how it looks like. This is a snapshot of data coming from Rhythmic. These are not aggregated data. You can get also aggregated data from Rhythmic. The difference between all data and aggregated data is that aggregated data are sampled. So there is a difference between real data, market data, with every traded level or every available level. Also aggregated data, which are sample data, for example, or throttled data. Therefore, we recommend Rhythmic or DX feed, because when you have, let me condense this as fast as I can. You see, we are talking about every level between, let me say, roughly 120 and 92. Everything what is available here between those levels is exposed here in the book, shown in the book. And this helps us to understand really what is going on. There's a little bit of difference between the X feed. It's also everything you can get in the book, and the Rhythmic. You see there's a slight difference between those data providers. But at the end, we are talking about high quality data, and we get every level. You can find a comparison. You can aggregated data or limited data are good enough for candle and similar charts, and for retail orders, traders, and it's absolutely okay if you're working with normal charts. If you are working with these decisions to trade stocks or futures, you can use all these fine tools we have learned this week without any hesitation, because this is all true when the data which comes in are high quality data. With non-aggregated data, everything is disclosed and we can decide according to the displayed information, and we see all levels are available and thus we can plan and trade accordingly. That's the point. We need to make decisions to understand what is going on. I kindly and would like to motivate you and kindly ask you, think about having the right data in front of you. You don't need it when you have this one, candle charts, but you will need it if you're going more in data depth and DOM and limit order book trading and its visualization here in this with the software with bookmap, then you will have to have the need for high-end data. There's a table on the wiki, on bookmap wiki. They have done their research on different data providers here. And that's the output if you are trading different data providers. So unfortunately, I don't know what is what. You see the difference. You see the difference really in the provided data for this market. Absolutely. You see the difference. This is not tradable. You don't need bookmap to trade this. There's no meaning. Nothing. Even this one. It's really hard to trade. What do you want to see here? As well as here below. Really, I kindly ask you to think about your data feed. Option expiration, before we come to the end, is a nice point you should keep in mind and put you on your calendar, because option expiration days have a high correlation with following indices ES, NQ and YM. Statistically, probability is greater than 80% that on these days the indices will probably correct. Mark the option expirations days in your calendar. It's only a reminder, you know. It's easy to put the option expiration. There's an option expiration calendar. You can find it in the internet. It's really easy to place these dates, because I'm sure, at least I am speaking for myself, I don't think on Fridays when that happened that this is an option expiration day. But in most parts, when we have option expiration, be careful, be very careful. Most of the time, the ES, NQ, YM are going to correct, and then then they're pushing in the opposite direction. So please be careful when you see or read or have in your calendar that we today have the day is an option expiration day. It has an influence on the market. It's just a reminder. It costs nothing. Keep it in mind. And when you are doing your daily preparation and it's option expiration day, please keep in mind that the correction is likely to happen, and then it helps you to justify your decisions a little bit better than without this knowledge. It's just a little helper, nothing more. Okay, guys, we have spend a lot of time in discussing and working around the seminar, bookmap masterclass strategies and profitable trading with limit order book and bookmap. We are coming to an end. I don't want to get to this trading advice. Please read it on your own. I'm sure you are experienced traders. You don't need any advice. If so, then find your own your own mantra for trading. You don't need anyone. You are absolutely skilled and know what to do. So I would like to skip this trading advice. Guys, thank you very much for this week. It was an absolutely exhausting week for you, for me, but I'm extremely happy to went through this material this week with you, because I think it is the most comprehensive part about market mechanics based on limit order book and bookmap. And also the practical part is a part which I have experienced by myself, and I'm constantly working on it to adjust it, to trim it a little bit more. I think that's the best outcome I have experienced by myself over the last month, the last year. I would like to motivate you. Leave a reply on my webpage. It costs you maybe 5 to 10 minutes, but it might help other traders. Now you're in the position, from my point of view, you're in the position to to adjust your trading around this knowledge, to trim your trading around this knowledge. It will help you to stay profitable, and that's my wish. If you need additional information, if you need support, come back to me. I'm here. I kindly invite you to log on here to the Ecofin room. You are free to use the data flash during your trading day. It is really helpful to have it on your desktop. Intention is to make you independent of everyone, even of me. You should understand what is happening in the market, and you should utilize this knowledge for your own trading. Thank you very much.